Okay, hello, how are you? It's good to be back. Uh, I'm trying to put a video together, show you how I trade on a daily basis. Before I can do that, this sucker comes up every minute, I can say. Before I can do that, I have to tell you the difference between the Forex market, which I'm currently trading at, and other markets like the stock market. So, as you can see from this chart, which is supposed to pull up right now, boom, in stocks, we're expecting the share to increase in value over time. And this is what happens with 99% of them. They start at a value really low, like this one, almost zero, so it's dealt in cents, and then starts appreciating or going up against US dollar until it gets to crazy value, to unbelievable value of $130, Apple's top. What difference does it make with a currency pair? Let's switch to a currency pair. This is Euro Australian dollar or Euro Aussie. As you can see from this chart, um, it's really hard to spot a trend. I mean, it's on merely oscillation. Now, starting from 1994, it started to go up, down. It's kind of expanding triangle in the jargon and lingo and lexicon of eliticians. What do you call these guys? And then going backwards in a contracting triangle, or you can call that a ABC, and then dropping. Can you find, for Pete's sake, can you find a legitimate, a distinguishable trend that everyone can argue on that? I mean, with this one, the trend is undoubtable. Indubitably, it's an upward trend. And show me a person who testified that starting 1990 up to 2016, we didn't have an upward trend. So this is the change. This is the difference between the nature of stocks, bonds, commodities, and, on the other hand, forex pairs. We can go into philosophical, technical, scholar point of view and discuss the main reason behind these things. I've done that in university, but this is not a place. This is a place for practical and applied stuff. So, without further ado, let's discuss. Let me tell you that there's nothing to discuss because you can't talk to me and give me feedback. Let me give you what I mean, what I try to infer from this situation. Okay, so in forex market, we don't have a determined or indistinguishable trend in the long term, like in the monthly chart. What it means is that it's like an oscillation. I mean, it starts from here, we hear some news or something behind the scenes goes up, and it goes, for instance, up. Then after sometimes it corrects itself, everything change over, and something from the opposite side. Here, euro and Australian dollar, something from the Australia happens that brings the pair down, means strengthens the Australian dollar. So whatever happens, the moves are drastic. We call these trend moves. This bear move is drastic. And the corrections, look at here. The corrections are time consuming. So if this was a drastic move upward, the correction was time consuming. Let me tell you how much time it took for this bastard to go up. It went up in 450 days, a year and a half, or even less than a half. And then it took it 3,260 days to cover only 88% of the whole upward movement, and then another up move, which kind of navigated uncharted areas. And we can compare these two also. This huge down move took 1,200 days, but this up move, which didn't even cover more than 50% of this, took 1,100 days. Almost the same time, the same number of days, but the movement of the price in the trend direction was more drastic. And by drastic, by plummeting, by booming, boosting, busting, we mean sudden action in a certain direction, which means the movement in price is really large, but the time it takes for this movement is really small amount of time. In contrast, counter trend movements take so much time but don't cover um, much price. Okay, if you don't want to count days and price, the simplest way of doing this is dropping a line from the start to beginning of any impulse you can find. Let me thicken this faster. Okay, and let me give it color, more visible. Boom. This is the down move. If I grab another one, gives me this up move. Now take a look at this slope. If you can measure the slope of this one is really steep. I mean, if you want to slide down this one, God forbid you eventually might die. But if you want to climb this one, it is much easier to climb. So the corrective actions, the corrections are easier to climb, are easier to slide, which means the angular difference from the perpendicular, let me draw a perpendicular line, the difference from a perpendicular line, which is our touchstone or which is our measure, boom, the distance from a perpendicular line is much more than a trend direction move. This concept was around as long as Forex trading was around. I don't know if people use that. These days, many people are trying to use that in one way or another. But to use that and write books on this, because we've seen in Forex trading or in trading in general, any diminutive, inconsequential trading method is publicized. Look at different shapes of animals like crabs, and we call that harmonics. And those are all the rage, and they don't pay off as much as the fuss is about. But this thing, which is not something new, I've been trading Forex for at least 3 years, and I've seen that from the very beginning. But I didn't think it would work because I've read every single book on the market. This is a hyperbole, but I've read lots of books on the market. I didn't see them mention this concept of time and price movement, the steepness and the shallowness of the whole movement. I've not seen it discussed anywhere. And until now, I've seen people, and even in this website, TradingView, which is a free website I use for analysis only, um, I've seen discussed by a handful of traders, and everyone wants to say it is mine. It is my method. I came up with this, and they're probably right because there was no public information when they came up with this. They came up with this on their own, But the fact is, although they came up with this idea on their own, it doesn't mean they're only people who came up with this. The same time they were publicizing it, I personally already was done with developing a trading strategy based on this, because it was there, I observed it, and I implemented that. Okay, stop. Let's stop talking about historical events and go directly to what we call the trading strategy. So the whole concept is the market. And I told you the impulses, which is the trend direction, where we want to trade, is where the slope is the steepest, right? It takes less time than the corrections. These are Elliott terms. These are nobody's terms, nobody else's terms. Elliott came up with this something like 60, 70 years ago, and he's dead to kind of sue those people who are using this term uh, as their own lingo, jargon. Okay, as we can see from this chart, the trend is down. And if I zoom back or go back in time, I might be able to tell you that it's been a downtrend for quite a long time. Let's say starting from here, it started going down. Now, in downtrends, we want to sell. There is no conspiracy theories saying that we're gonna go against trend. Trend is for idiots. When you hop on trend, it's too late. Um, it's been established kind of rule or guideline that trend is your friend. We want to go with trend, but not when the price is at its extreme. We don't want to sell the bottoms, buy the tops. Okay. Price started going down, so it kind of broke the whole momentum of this one. And by momentum of a previous trend, we can use a really old traditional method of capturing and computing momentum, which is drawing a simple trend line. Okay, you start from the very low, try to connect as many lows as possible, and boom, your connection is 1, 2, 3, and kind of played it around, and then boom, broke it. So we broke the momentum of the upward trend. This is the first indication of a downward trend. So do we sell right here? No. This is our first criterion of the trend, that the trend has changed. Okay. The next thing we want is an impulse, because we don't want this trend to be broken and the price start going sideways. If I can get it right, yeah. Then the price start going sideways, something like that. This is not a trend. We don't want this. So what do we want? We want to break the trend line, then have a steep movement. This is our indication that trend has reversed. Okay, so when do we enter? When do we place an order? After an impulse, we're looking for a pullback, right? This is everything everyone says these days in the market. Only the implication or the application of this idea is different among individuals, which gives way to different strategies. But the whole concept is the same. The trend is broken, we wait for an impulse, then we wait for a pullback. Pullback is not any pullback. Many people see, okay, this is an impulse downward, and this is a pullback, and they're failing to see that their alleged pullback is steeper than the original impulse, and they start buying right there. I'm sorry, they're selling right there and using some fancy Fibonacci tool that I stopped using a long time ago to say, okay, let me draw the Fibonacci tool, my fancy Fibonacci tool. Boom, this is 78.6. And I drew that randomly, drew these lines randomly. These are the numbers everyone has. 382, 50%, 618, 786, 887. You see there's so many lines over here that you can draw anything. Let me remove that. You can displace, put it anywhere, and we have somebody draw this line and try to justify that. Okay, this is the best time to sell. Let's look at this one. This is boom, bang on 50%. Can you see the bias or the kind of fallacy they're putting themselves through by using these Fibonacci tools and adding numbers every single decade? The last decade we didn't have, last 2 decades we didn't have 88.7. They were so happy to discover this line, 88.7, and what we're seeing is the number on these lines, or the number of these lines is increasing every a decade or two. Every 10 or 2 years we see another line. It gives way to subjectiveness of this whole phenomenon. I can move this line to somewhere else, we hit another line. So this is why I stopped using Fibonacci as my way of analysis in intraday trade, because it's a self-fulfilling prophecy. Whatever you do, you'll get a number. And I drew them randomly. I got to the numbers. But what if we don't hit 50 bang on? We hit 50 a little bit lower in between, and say, okay, it kind of missed. It's almost 50. It's almost 38 too. So they'll justify it eventually, no matter what. So the problem with this line was that it's not a pullback because it's more impulsive. What we're looking for is a sideways consolidation with a shallower, more gentle slope, like this one, not this one, and then the continuation of the trend. Now, question: do we find this in every single chart, every single time? No. If this was the case, we had to be placing all orders, and we have to be in trends 24/5, 24 hours a day, 5 days a week, and even over the weekend. We have to keep our trades. And how many currency pairs do we have? 30, 40? I mean, it's a good thing. The rarity, or the um, the fact that it's not happening all the time. I mean, it's a good thing. It prevents you, stops you from over trading. Okay, this was the fact. So the trend has changed. Now we're looking for a place to go with the trend. I kind of messed up with the chart. I'm sorry. Zoom back. The reason I'm zooming back is I don't want to get mixed up with the candles. To me, candles are a little bit distracting. I mean, look at the body of the candle, the wicks. I start getting involved, putting my mind onto the candles. I forget the whole structure. It's like getting distracted by the trees and not being able to see the jungle. Sometimes I switch to bar charts, which doesn't make much difference for me. Look, the same structure emerges and shows itself to me. So there's no difference between bar chart or candlestick, at least in analysis portion of your trading. So we have downtrend. Where do we start to go with the trend? We're looking for opportunities, and I'm not seeing any good instruction opportunity right now. One thing to consider, that this is not an impulse and this is not a pullback, this is not a correction, is this. First, let me draw my touchstone or guideline, boom, a vertical line, and then we'll be having the two trend lines. First, it starts from here up to here, and the alternative move starts from here up to here. Is there any difference between the slope of these two things? These two things almost have. If it's not visible by the eye and you have to grab your mathematical geometrical toolbox, it doesn't mean anything. I mean, it has this website draw the angle. I don't know if it's with this chart, with this tool or the other one, but it has the ability to show the angle. But we don't want to use computer to tell us whether it's impulsive or corrective. Visibly, the slope of this one and this one are is identical. Look at here. So this looks like another impulse. We don't want to sell at here or here. Let me switch to another currency pair. Okay, let me zoom back. The same thing, it was an uptrend right there, for instance. We broke the trend line right here, right there. Drawing trend lines sometimes is arbitrary, but we're going to develop a way of making it more objective than subjective. But nonetheless, we broke the trend line. Now the trend could be perceived as downtrend. Now every consolidation can be perceived as a correction, but we're not going to trade every consolidation. But because we see consolidation like 10, 20 times on a daily basis, I don't want to have 10, 20 trades on a daily basis, and their failure rates are annihilating. Not only you won't make money, you lose money eventually. So this is one consolidation which could be trade, but I suggest you not to. Boom. Let me tighten this up. Boom. As you can see, it dropped from here, then went into consolidation. It took a lot of time, didn't go nowhere. And then boom, it continued its downward movement. Now this is what I call a good impulse and a good pullback. Right there, right there. You can see the difference between the slopes, right? The difference is clear. Came down close to the perpendicular, the normal, and then a gentle slope. This is what we want to trade. This is what we call impulse correction or pullback. We don't sell at the top because we don't know where it terminates, but the old prophecy or philosophy of trading, of using trend lines, is going to help us in this case. We draw a trend line When we see this movement all the way to here, we draw a trend line that encompasses the whole movement. This is the trend line. When the trend line breaks, we're gonna sell. How are you gonna sell this, and where are you gonna put your stop? It's really a personal choice. Zoom in. You might put a sell stop right below the line. Wherever it breaks, you'll be in the trade. You get a better price, but more risk, because it might solely break the line and then go back up, continue its upward movement. Remember, what we're saying here is now 100% foolproof, 100% error proof. These are probabilities in the market. Market eventually will do whatever it wants to. So, what is my strategy? I wait for. First, I switch to a more convenient time frame, which says the number of candles we want to trade shouldn't exceed 20. Should be around 10, 20, with a level of tolerance for more or less. So the number of candles here is 17 bars, the whole upward movement. So it's safe to trade this in the 240 minutes chart or the 4-hour chart. Then I wait for the breakout, which is here. Then I put my order, my short position, under this basket. A tick or two under this basket. My stop loss goes above the previous structure plus the pip, and I take off 101, 102, 103, 105, depending on my trade size. I mean, I take partial profit at each step. Okay, so as you can see, 101 is hit. Then I see what 101 hit. I close my, I'm sorry for some inconvenience. Zoom back. Come on, trading view. You're a good boy. I'm really sorry for this. Then I move my stop to break even. That would be risk free. That would be kind of risk free, not totally risk free. As you can see, it hit 101, then it's going back and stopping me out. So I took one portion of profit and I lost nothing. It would be one, normally it would be half my profit locked in, and I'm stopped out. I don't I don't receive more profit.